We are back once again with our guest co-host Ryan Lewenza, portfolio manager at Raymond James. REITs are top of mind for him, as he says REITs are having a decent year. They're up 10% so far?
Yeah, 10% in price. When you add in distributions, maybe about 13, 14%.
What's driving that?
So there's a couple things happening. So one, there's been a little bit of M&A. So there have been a few large acquisitions. And of course, when you take out a company, you get a little bit of a premium price. But I think more recently, it's the Bank of Canada. Going back to what we were talking about in the last segment, they're starting to cut again. So was it 2 weeks ago that they cut by 25 basis points? I think our overnight's at 2.25. And I think there's probably another couple more to go. And so if you cut the short end of the curve, you shut those short-term rates, it might bring down the long end. So here I'm talking about the government of Canada 10-year bond yield. That's one of the most important things to be looking at. And so if that comes down, that's good for REITs. Why? Because there is a long-term negative correlation between Canadian government of Canada bond yields and the REITs. And so in layman terms, just keep it real simple. When interest rates are coming down, that's generally good for REITs, given this kind of negative correlation. And so I think as the Bank of Canada continues to cut rates, this might boost REIT prices even higher. So they really benefit from lower rates.
And right now there's a decent gap, isn't there, on that correlation?
That's correct, yeah. And so why do REITs benefit from these lower rates? Well, there's two key reasons. Number one is we kind of call them a bond proxy, meaning an investor will look at REITs and say, hey, I can go buy a GIC for 2-3%, or I can get a REIT that's paying 5%. And so when those interest rates are coming down, when those GICs are coming down, it makes that REIT yield look more attractive. And then secondly, a REIT has a lot of debt, right? They go out and they buy a bunch of commercial properties, they buy warehouses, and they've got debt. So as that debt's coming down in interest rate, the interest expense goes down, more profits. So they benefit a couple different ways from these lower interest rates, and that's why we like them. So there's one we like is the BMO equal rate REIT ZRE. That's around $22. I think it can maybe get up to $25, $26 over the next 12 months. And
are you looking at, is it mostly equity, or are you talking mortgages, hybrid? Which one do you think?
So this would be on the equity side. So we're focusing specifically on, so we're not going to get into the debt of REIT companies. I'm talking specifically their equity exchange, trades on the market. So we're talking the big ones, the RioCans, the Canadian apartment REITs, some of these large commercial properties. Another thing I think that's helping these REITs is I think the commercial office properties is starting to stabilize. Right? We had the highest vacancy rates in decades because of COVID and working from home. Royal Bank's back at 4-1. Turner Investments is now back 4-1. So all my staff is now coming in 4 days. So when you're down on Bay Street, when you're walking around the concourse, it's picking up, which I think is great for a number of reasons, right? Just helping that economy, getting these businesses up and running. And, frankly, I know I work a little bit better in the office.
I think a lot of people have found that. But is it jumping on the bus or jumping on the bandwagon a little late with everybody coming back when it comes to those commercial?
Better late than never. But I still think these commercial REITs, the vacancy rates are just starting to pick back up. I'm hearing how, like before, there was a lot of inducements. Oh, you want to take on this floor? We'll let you do some renos. We'll give you a big one-time break. Those are now starting to go away. So it's definitely the early stages of this recovery in the kind of the office properties, which I think is good for a bunch of reasons.
And are the regional REITs? Can I say
Yeah, there's definitely REITs that will focus on more in Alberta based, or some are more in Ontario based. So it's definitely a geographic. But what you found is in recent years, they're trying to get away from, like in the Alberta, Calgary, right? The H&Rs, those really got hurt because of the economy during that big energy sell-off. And so they started to diversify more around Canada, even down south. So there's not as much regional, but you still get that.
Okay, and what about outside of Canada?
So then the REITs in the U.S., we like those as well. They have that same relationship, that negative correlation with those interest rates. Plus the U.S. housing market is starting to pick up. U.S. mortgage rates have come down a lot, and I see a stabilization there. So U.S. REITs would also benefit from these large trends because the Fed's going to be cutting rates as well.
Is that the better place to look, or staying in Canada?
I'm still sticking in Canada for my REITs. I just a little closer to home, and I can just more familiar with them.